Hello, everybody. Thank you, Amina, for the kind invite to the AI and Data Science in Trading Conference. It's a pleasure to be a participant to the conference. My name is Francesco Filia. I am CEO of Fasanara Capital. Fasanara Capital is an asset management company based in London. We manage around 1.5 billion euros, for the most part exposed to granular portfolios of corporate receivables. We've been in business 10 years. In April is our 10th anniversary. Prior to Fasanara Capital, I used to work at Merrill Lynch for 11 years, and prior to Merrill Lynch, I was at JP Morgan for 3 years, starting my career in 1997. I will present some slide to give you a case study on how to utilize machine learning for prediction in private markets. Let me start saying some words about our asset class. As you know, we live in a world in which negative rates are becoming the norm. More than 86% of bonds outstanding are yielding less than 2%. More than 60% of bonds outstanding globally are yielding less than 1%. This is a very specific moment in time in which it is very difficult for, especially fixed income investor, to know where to put their money at work. Typically in days like this, you need to go into extreme maturity extensions in order to extrapolate some little margins over LIBOR. And the question arises of how should we do and what should we do as a rational investors when it comes to really very difficult markets such as these ones, in which so many bonds are yielding zero, and so many of them, more than $15 trillion equivalent across the globe, are yielding negatively. And at Fasanara, we try to give an answer utilizing cutting-edge technology and the new innovation, which has been allowed by the digital revolution and digital disruption. So, as you know, there are some macro forces at play in days like these, like machine learning, artificial intelligence, but then also quantum computing, together with all of the rest that is surrounding the environment, like ESG, like healthcare, like 5G, and like also the energy transformation. The big trend that we see in the market in days like this is one where banks, especially in Europe, are retrenching from the SME sector in particular to focus on mainstream vanilla markets, which means really focusing on the large corporates only. This is happening because of one or two reasons. One reason is regulatory capital constraints. The banks are particularly capacity constraints when it comes to capital. And two, the lack of IT and an appropriate technology in order to be able to depress the cost and still keep the revenues unchanged, which means increasing the margins. At the same time, you have institutional investors, especially pension funds, insurance companies, which are looking for alternative to fixed income allocations, due to the fact that there is a zero interest rate environment. The third big trend is technology. As we said, that the ability to look through artificial intelligence and machine learning at big data analysis, which gives you the ability to do the job that banks used to do, but at a different level, with much more efficiency, and therefore less cost, and offer the access to the asset class that used to be constrained to banks only, to institutional investors. So institutional investors are stepping in. They're substituting banks when it comes especially to providing the real economy and the SMEs in the real economy, which means small and medium enterprises, with working capital financing. And this is the space where we are active, and this is the space that we will discuss today when it comes to machine learning and artificial intelligence. It is the space otherwise called the factoring space. Factoring means those SME suppliers that they sell goods and services to large corporates, and when they do so, they issue invoices. And those invoices are issued for a very small amount on average, and they for a very short duration, typically 60 to 90 days, and they turn therefore multiple times a year. It is a very big market. It is 1.9 trillion just in Europe. And above that, there is the so-called funding gap, which is all those funding that does not take place within the banking channel that is left unattended. And it is very, very large. But let's just focus on the factoring, and let's just focus on fintech and what fintech can do in that space, thanks to the utilization of new technologies and big data analysis. Let me say that factoring is as old as you can think of. It is actually 4,000, if not 5,000 years old. It dates back to the times of the Mesopotamians. And it is as old as lending when it comes to commercial banking activity. Now, for the first time, you can do that business utilizing fintech technology and the big data analysis. Our own network of originators, the network of originators that help Fasanara Capital to source out corporate receivables from SME suppliers, utilizing data analysis, ranges across 55 different countries, with the blue countries being the ones in which we have boots on the ground, and the yellow dots being the largest countries where we operate. As you can see from this map, we are particularly present in Northern Europe, especially the Nordics, Benelux, Germany, UK, and Ireland. UK is our largest country at 18% of the total NAV. In peripheral European countries, we are present in Italy and Spain, respectively, with 10% of NAV and 7% of NAV. Then we have around 10% of our activities in Asia, between Hong Kong and Singapore, and around 15 to 20% in the US. The portfolio is made of very small positions. 95% of the NAV of the portfolio is made of positions of less than 50,000 euros. The amount of data that you can deal out of the fact that there is a very short duration is staggering. Here you're looking at our volumes, so total cumulative traded volumes over the past 7 years. And you can see that we exceeded 4 billion euro volumes in 2019, 8 billion volumes at the end of 2020, and we are set to cross the 20 billion figure by the end of 2021. Now, this is a very relevant chart because the message in it is that you have a lot of data points that you can utilize in order to do machine learning and artificial intelligence, in order to apply your own analytics, to learn from the past database that you have accumulated and do pattern recognition to spot anomalies in data price time series and so on and so forth. The type of data that we record is both traditional and untraditional. When it comes to traditional data, you're looking at very traditional measures and the financial indicators like financial variables, leverage, liquidity, profitability, coverage, activity, like a corporate governance and managerial variables. So a little bit more qualitative indicators like the size of the company that is borrowing money from you, or that is the ultimate obligor in the transaction of factoring, the industry sector, experience of the managers, the location, the number of the board members. And then you can also record and store more macroeconomic variables, like the GDP of the country in which they operate, the borrowers and the debtors, the unemployment rate, the consumer price index, and the interest rates. All of these can be recorded, and the more data you have, the more better analysis you can do, the better rating assessment, and the better ultimately also ranking and pooling of the assets. The more volumes, the more data, the better visibility, and the better visibility, the better investment decision that you can do. It is a virtuous cycle. The data analyst in the audience will know this better than me, that basically the more it goes through, the more you're able to do better prediction of defaults, the better prediction of days delays, the better prediction of fraud detection technique. You can create a lot of early warning signals within your database across the multiple risk factors of your asset class. Obviously, like the multitude of the data is really helping in creating value for your database, right? So the fact that we operate with 70 plus originators on more than 8 billion volumes cumulatively historically, on more than 300,000 positions outstanding at each point in time, coming from a platform database of more than 600 platforms and from more than 55 countries. This creates variety and diversity in the quality of your data. So when you rank data across, you can see that the four V of big data, according to the University of Cambridge, the variety, the velocity, the volume, and the veracity of the data. All of this contributes to the richness of your database and therefore also your analytics. The type of data that specifically at Fasanara we record and the way in which we classify is as follows, as you can see in this slide. So there are traditional data, which they have got to do with the AML, KYC of the underlying borrowers, initial fraud detection techniques. They go through the credit fundamentals, which are audited financials, and leverage liquidity, profitability, and activity indicators. And then obviously also the cherry picking of the individual invoices and factoring arrangements that we have been performing from the side of Fasanara. Then you have proprietary data, which is the enlisting of blacklist that we've been going through. Transactional data, because there are also transactional ratings of the specific transaction that Fasanara decided to do. And then also data at the level of the originators. Then you can further do data augmentation and data enrichment by reaching out to third parties for validation of your data stack. And finally, you have also more untraditional, unconventional data when it comes to, for example, like the IP addresses of the email from where the notifications of the invoices were sent out of, and so on and so forth. Data providers globally are very many. We think about the rating agencies primarily, or the credit bureaus, or the business information agencies. It goes from Bureau Van Dijk to Duff & Phelps to Mod Finance, Wiser Funding. If you're in Italy, Cerved and Cribis. If you're in Europe, Amadeus and Orbit, and the FactSet, and a lot more data providers. These are both data providers that Fasanara reaches out to directly, and that they are provided to us indirectly by our fintech platforms, which are all data enhanced and all data sophisticated in terms of APIs, in terms of ways in which they can retrieve data from the economy, and therefore that we can suck out of those providers in order to do a better data augmentation at our level. In addition to this, we also have the trade insurance like Euler Hermes, Atradius, Coface, Tokyo Marine, QBE, Lloyds, AIG, and so on and so forth, in addition to also the new tools made available by the regulation of PSD2 and also open banking, like for example, in Europe you have the Yapily, you have Credit Kudos, you have TrueLayer, in the US you have Applied. All of these are data sources that didn't used to be there just 5 to 10 years ago. They've been really emerging in the last 5 to 10 years, and especially in the last 5. Most of the data has been produced in the last 2 years, I would say, and 90% of the data available has been produced in the last 2 years, and this will keep on happening over the course of the next 5 to 10 years, meaning that to keep abreast of these new trends, you need to keep improving your data sources and being voracious about the new data sources as time goes by. Our data process, to give you an example of the way we think, is the following. So we ingest both structured data and unstructured, unconventional, untraditional data. We process it, which means we clean it, and then we store it. Everything is stored by our technology team and our CTO, which is Altin Kadaraya. And then we do 3 things for when it comes to our own business model. We do credit risk, which means the determination of the credit ratings. We do fraud detection, which means that the early warning signals when it comes to fraud detection techniques. And ultimately, portfolio optimization, which is machine learning enhanced direct allocation across mandates of a certain universe of origination in automatized ways, which they can minimize the human interaction and make sure that the process runs smoothly, because unless you do that, you will never be able to do such a big volume data job in an efficient manner. To give you an example of each, very briefly, for example, multi-layer analysis, machine learning, when it comes to early warning system in frauds. Here you come to the determination of a specific probability of fraud for a specific invoice, which is produced by a specific originator in a specific country against a certain sector and into a specific debtor. And your database is very big. As we have said, it is made of traditional and untraditional data. And you go through a multi-layer analysis in which you cross-check information one layer after another. You start with the identity of the company. Then you move into the validity of the trade information, the specific invoice contract. Then you cross-check, you cross-validate the information against multiple marketplaces, multiple debtors and multiple sellers. You may be able to trade one invoice with one seller. That single seller, you have more than one debtor, you have probably 3 debtors. To a specific debtor, you have more than one seller, probably you have 5 sellers that they sell Amazon invoices, for example. And then you have, for the same debtor, you have more than one marketplace dealing with it and more than one seller dealing with it. So you can cross-check all of that information. And by keeping a top of all of this information and data provision, you can determine whether or not you have some red flags and some suspicious pattern recognition across your database historically in that specific layer. Then you cross-check everything against your stakeholder blacklist, because over the years we have created a long list of blacklisted borrowers and blacklisted stakeholders that we do not want to have a borrowing relationship with, and therefore we can cross-check whether or not there is any flag. If everything is filtered through and the invoice makes it to the end, at the end of it, you have a certain probability of fraud for the specific instrument. Now, if that probability of default is high enough, then it compels you into further investigation. So at that point, the process moves from being data-driven to being taken over by humans. So at that point, the red flag goes and gets sent to the investment team and the origination team, depending on whether it is on a specific invoice or on a specific originators. And those teams are going to be doing more manual jobs. So picking up the phone and investigate it further to see if this probability of fraud is indeed conducive to something that we should be concerned about and interrupt the borrowing relationship or not. Typically what happens is that we would receive an answer and an explanation as to why this invoice looks particularly different from the past in terms of frequency, average size invoice, or in terms of the seasonality, that time in the year in which it has been produced to us, or whether there is a completely reasonable explanation for the invoice. Depending on the whether or not the answer is satisfactory, we will decide whether or not to discontinue the borrowing relationship or not with that specific borrower. What we have achieved in this early warning system is not so much the ability to avoid completely the risk of fraud, but at least we have been containing the risk of fraud to a statistical outlier, to a random error. You make sure that it doesn't reach the point where it becomes idiosyncratic risk and particularly damaging for your portfolio at the aggregate level. If you are able to do this consistently, you're able to block the compounding effect of a certain borrower being working with you for too long. If it is working with you for too long, what you will be hit by is by, like probably a complacency effect, which means that automatically the ratings on that borrower will increase because the borrower has been with us for long enough, and automatically also the credit limits will be increased. So instead of the average size of that invoice being a 50K, all of a sudden you will find yourself exposed for 5 million after enough number of years have gone by. So you need to stop that compounding effect. That is what the fraud detection techniques and the early warning signals on frauds is dedicated to. Not so much about annihilating it down to zero. That's impossible, mathematically impossible, but you want to keep it in statistical insignificance. And that can be done by a big data analysis once you have enough data to play with. Another example relates to the probability of default determination. So here we carry a usual cluster analysis, which is run by our technology team. It is fully automatized. It takes all the borrowers in a certain selection, and it determines that the probability of fraud is 4.2%. Then we do a subcluster analysis, and we consider only connected borrowers. And this can only happen through the data point of view. It cannot happen manually. The naked eye will not distinguish between the borrowers in the connected borrowers list. There will be one manufacturing company in Spain, and then there will be one chemical company in Germany. They are not in the same sector. They are not in the same industry. Technically, they look like they have nothing to do with it, except from the number standpoint, they have a lot to do with each other because they're very connected. It could be the same number of invoices at the same or similar times in the year, so with the same seasonality, the same number of invoices or average size of invoices. It could be some board member connections. It could be really anything. And obviously, these connected borrowers may show, in this illustrative example, a higher probability of default of 11%. Again, the naked eye wouldn't be able to see this. The human interaction wouldn't be able to do much about this because these are very granular portfolios of more than 10,000 positions just on this subcluster. But what you can do, if you apply technology and data-driven diligence and data-driven risk management, you can put a tech filter in your AUM, in your portfolio process, where you contain this subcluster of borrowers, connected borrowers, however defined, to a certain maximum level of NAV. For example, 5% limit. And you can do that time and time again across different subclusters, to no limited number of connected borrowers, however defined. And you can put more and more tech filters across the portfolio. And this at the end becomes data-driven risk management and data-driven asset allocation, proper data-driven. Ultimately, you can also have a third dimension, which is like a full-fledged portfolio optimization coming through machine learning, going from the dimension reduction module into our own specific election of the best machine learning tool to utilize for our business, which we have determined to be, our technology team has determined to be the long, short-term memory neural networks. Obviously, when you come to machine learning, you have different things that you can think of. And we have been ranking, as you can see in this slide, several different types of machine learning techniques, from random forest to gradient boost. And we have been applying them to different verticals in our business, from SME loans to invoices and receivables financing, to business loans and to other type of loans. And we have determined, ranking all of them against each other, that our own preference, depending on our asset class, is this one, is this LSTM neural networks. Again, there is no limit to the number of tech filters that you can impose on your portfolio. And here, for example, in this slide, we show you a snapshot of how they look like in our own internal live dashboards. And you can see that each one of them looks at a specific different subset of the data and a specific feature of the data, attribution of the data. And you can see that at some point in time, you can determine whether or not some of them are turning red, which would mean a red flag on that specific vertical. And then you create a heat map at the bottom of your live dashboard, where you see red dots popping up depending on how many of these monitors have been turning red. And at that point, this live dashboard is visible to our investment team. Depending on the density of red in the heat map, our investment team will be compelled to worry, certain degrees of worry, and compelled into further investigations of specific invoices or specific originators. This is how it looks like, and this is the way the tech team tries to communicate with the investment team and the origination team. This is when the process becomes from machine to man plus machine. This is how the interaction works. Our tech team also looks at more sophisticated tools like natural language processing. We have our own development of AI chatbots, so ways in which we can vocally interrogate the database and ask them, for example, how much of the portfolio is delayed in Finland on certain subset of invoices, or how much of certain amount, how many companies they rank in certain ratios from the net debt on EBITDA standpoint or from the currency standpoint. These are AI chatbots that our team is working on. In the end of the day, machine learning can do a great job when it comes to granular portfolios like this, credit portfolios and the private debt market portfolios. Obviously, there is an ability to, through machine learning, identify patterns non-linearly. A linear analysis would be completely unable to spot outliers, statistical outliers, whereas machine learning can do better pattern recognition and better analysis of non-linear data sets. Days delays prediction models are very useful, and they can be utilized through machine learning techniques. What our team also does is benchmarking of the specific invoice against themselves and their history. So, for example, in this slide, you see the example of a market benchmark created for the specific borrower against its own curve. So it's not in aggregate against the market, because it would be too irrelevant and too difficult to utilize. So we give a rating to the specific invoice that we trade, and then a specific benchmark, which means where we should be buying that invoice at that specific point in time in the year, depending on whatever else is happening, and against its own history. And you may find out that there is a period in which you should buy the invoice, and there is a period in which you should sell or not buy the invoice. And depending on that, our technology team is giving to the investment team the tools that are required for the investment team to be able to manually then take the decision, the right decision, but the decision to be data informed and data savvy. I would probably close here. I probably have run already over time. If you want more information about us, you can find it on our portal at this link. And at the same portal, you will find also our research on machine learning and digital future, which means digital lending and digital assets. And I hope it was useful to provide you with a case study of how machine learning can apply to private markets. feel free to reach out for further investigation, and I wish you a nice continuation of the conference. Thank you very much.